Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about the AI trade as we look ahead to 2026, which leads us to our word of the day, productivity. It is the holy grail for central bankers that lets you juice growth without runaway inflation. And it's all thanks to our little chatbot friends. And chip maker Micron has been ripping. On today's Market Show and Tell, we're going to translate the ride using one word that explains why it can feel like a roller coaster, beta. And this episode is brought to you by the number $309.22. That is the estimate for next year's S&P 500 earnings per share, which would be a record. We're going to tell you why rising corporate profits have helped justify soaring stock prices. And today we are welcoming Hardika Singh. Before she joined the market intelligence team at Tom Lee's Fundstrat, she covered financial markets as a reporter at the Wall Street Journal. And nowadays she's producing macro and stock market research for Fundstrat's client notes and also their strategy work. So Hardika, it's great to see you here. Before we dig in, any surprises from 2025?
I'll take the easy one, tariffs and Liberation Day.
Yeah.
I was actually off at that time. I was on my way to Cancun.
That's your fault. Okay.
Cancun, of all places, too.
Yeah, and my husband and I, we took this trip and we were like, we're not going to look at our phones. We're just going to be completely detached. Second I land, I'm seeing all these headlines and I'm low-key having a panic attack of sorts. I'm like, oh my gosh, what's going to happen to stock market? And then what was funnier was that Tom Lee, who, is typically has a more bullish outlook because he's so long-term, he was still bullish on the stock market. And he said that, stocks fell so much so fast. So I think that they could recover. And at the time, I didn't really see it, to be honest. But later on, he ended up being right.
Win for Tom Lee and the Bulls.
Yeah.
Seriously. What a year it's been, though. But I do want to get to our word of the day. And that word of the day is productivity. Now, it's pretty simple. Think of it as a ratio, output over input. It's how much we produce in goods and services, the output, over the amount of hours worked, the input. The more we increase output relative to input, well, productivity increases. And central bankers just love this. And here's why. It means the economy is growing without inflationary pressures getting too high. And that's because we're all able to do more work throughout the day thanks to our AI pals. That's the big picture here. Hardika, what are some specifics that Fed Chair Jerome Powell is looking at when it comes to this productivity gains?
So the most important thing and the biggest takeaway for me at the last Fed meeting was that for the first time ever, Chair Powell said that people who use AI are likely more productive. At the September meeting, what he said was, yeah, it's probably making people more productive, but it wasn't a clear-cut answer. But now we're hearing that even he, as a central bank chair, is noticing the transformational power of AI. And the biggest example of that comes in through the dot plot. So if we look at the dot plot that was released at the last meeting, we see that they actually upped their expectations for where GDP is going to go next year. It's at 2.3% for 2026. And in September meeting, the expectation was 1.8%. So it's a huge jump, right? It's a huge jump. And what's even more surprising about this jump is that they lowered their inflation expectations. So next year, they expect inflation to be at 2.4 something compared to 2.6 at the September meeting. And the only way, or like one of the biggest populist theories that these dynamic forces can exist together is that productivity is improving, which is so crazy to think about because GDP is just basically consumer spending. And if people are spending more, it can push up the demand for prices, push up the demand, and it can lead to higher prices. But at the same time, the Fed doesn't really see that happening. So it means that they're probably going to expect AI to lead to higher productivity.
I'm going to rewind here a little bit, and this is way before both of your time, but in the late 90s, we saw something very similar evolve, which Alan Greenspan. He was the chair of the Fed, the market whisperer. You couldn't understand anything he was saying, but he did say that productivity was increasing. In fact, it was. And so just back to my original statement, or Brooke, as you were breaking it down, the chance for inflation, although it still exists, is a lot lower. And that's why the central bankers love this. So, I know that Chair Powell, he wasn't all in on productivity just yet. He was kind of hedging his bets.
Right.
But, if this continues, how does this play out in 2026?
I think, well, first of all, productivity itself is really hard to measure other than this formula. There's all these intellectual arguments about what's the best way to measure it and whether AI is actually showing up in these numbers. And it's still unclear, even though he did give a really clear signal. And I think for next year, what remains key is for companies to actually start demonstrating it. What we have seen in earnings calls and plans outlined for next year is that companies aren't really looking to hire more people. They're looking to do more with less. They're looking to be more lean, more efficient. So I think for 2026, the companies that can tout the biggest revenue per employee number will be the biggest outperformers. I think that's the story. And sure, it's easier as a tech company to have higher revenue per employee, but then you think about all these industries where you do need more people to do the manual labor, and for them, it'll be a little harder. So how do they come in, use AI to their benefit and improve their revenue per employee stats?
And I think the one thing that really isn't clear with Fed Chair Jerome Powell is the impact that AI directly has on the labor market. He references other companies like, we're maybe not word for word, but Walmart sort of saying that this is going to have an impact on jobs. So when you think about what Fed Chair Jerome Powell, the sort of the indifference that he has on what exactly this impact will be, and then the statements that we're getting from these companies, what's your team's outlook on the impact that AI will have on the labor market next year?
The hope is what the market wants to see is productivity increase and the labor market to continue to, improve, of course, but lead to jobs that are in sectors other than healthcare and social assistance. This job market this year, there's been really not all that much to be excited about. Sure, we haven't, just tanked completely, but we're surviving. We're not thriving in this job market. So I think the health and social assistance sectors, they can continue to do whatever it is they're doing so far, but we still need to see other industries participate in a meaningful manner, like construction, manufacturing. These are the typical sectors that drive economic growth, at least like conventionally, they're supposed to. So we need to see that. For next year, I think the biggest thing is whether these companies can continue to grow in a sustainable manner without needing more employees or without, and if they do shed more employees, can they still continue to grow their profit? We have seen Walmart and Amazon do a really good job at that, Nvidia too, but others not so much. So I think that's the trend that's going to define next year.
Excellent. And, as hard as it is to measure productivity, I have no doubt that AI is going to help us do that a little bit better. It's time now for Market Show and Tell, where we are drilling into the concept of beta. And we're going to use memory chip maker Micron as an example, which the share price of which has more than tripled this year. So huge run for Micron. And if you're on the Yahoo Finance app or website and click into the statistics page of Micron, you're going to find a stat called beta and a number that's about 1.55. So this means that the stock has tended to swing about 55% more than the broader market, and we measure that over 5 years with monthly data. So it's not a surprise that Micron stock has moved much more than the S&P 500 this year, but bigger swings also mean bigger risks, and the gains, while they seem quick, the pullbacks can come fast and hard. So I know you're looking at Micron from a fundamental point of view, and just make the case, why has the stock moved so much, and then what do we expect for next year?
So Micron's business is basically making memory chips.
DRAM.
Yeah, DRAM. That's right. So we did have to look it up earlier in the year, but it was an interesting stock. But what they specialize in and why they're benefiting so much in AI is basically because they stack those DRAMs to make high bandwidth memory, which is super useful for AI data centers. And as we all know, data centers, we just can't get enough of them at this moment. We need more and more. And Micron really fills this niche market gap where they can supply that HBM. And there's the strangest part about all this is that there's not that many companies that are making these DRAMs or HBMs. There's SK Hynix, there's Samsung, but they're South Korean. So you can't really directly invest in them. You have to buy ADRs. But Micron is really like one of the big players. And that's why they've benefited so much this year because they help fill that niche market.
And it's
gap.
driving up prices of consumer gadgets too, because
Yes.
we need DRAM in a lot of our devices. So.
Yes. So my husband, who's a gamer, he's been complaining that RAM prices are through the roof now because Micron actually in early December made the announcement that they're no longer going to make it for consumer segment because the demand for AI is just so high right now. They can't fill it up. So through 2026, they're actually completely booked out, they said, for the most part, which is just crazy to think about. But yeah, Micron is ripping higher because of that. And I am not necessarily a fan of this move, I will say, because if you pin it against the prices for, memory chips, you can see the move exactly relates to that. So it leaves the company's share price
Exposed.
very vulnerable, very exposed.
Yeah, it's very
to
cyclical.
This
unraveling.
in particular, just
yes,
that.
Yes. And as we saw back in early pandemic, when you make too much of these things, then you're just stuck with all this inventory.
Great point.
And then
Do you think we'll have a backlog of inventory, even though the CEO has said explicitly on the call that there's just so much demand?
Yeah, I don't think we'll have it this time. I do think this move can last for a little bit longer, but I do think that it's very vulnerable to becoming unraveled if we do develop new technology or another player comes in and says, hey, actually, I can help supply this. So the prices come down, and then Micron's share price is probably also going to come down with it. So it's not a sustainable move, in my opinion, but that doesn't mean that it can't keep happening for a little bit longer. Isn't the saying that like markets can remain irrational longer?
Then you and I can remain solvent. And that's kind of what
Exactly.
happens sometimes. Again, .com.
All right, guys, we do need to take a quick short break, but coming up, we're talking about what will likely be record profits in the U.S. and a run rate showdown between the two Kevins in their battle to become Fed chief. As always, it all comes down to the accessories. Stay tuned. This episode is brought to you by the number $309.22. That's the estimate from FactSet for the next year's S&P 500 earnings per share, and it would easily be the highest on record. And this matters because a lot of people are getting nervous as some valuation gauges are putting the market around the expensive levels we saw during the dot-com era. And if earnings are hitting records, maybe record stock prices are, justified, or so the thinking goes. So Hardika, tell us how you're seeing these companies' earnings versus the stock price right now. Is it justified?
100%. And they can easily go even higher. I think at least for next year. That's what our view is. I would say that with valuations, a lot of people are really worried about, them being too high, close to perilous levels from dot-com bubble. But I just don't think that's an argument that's solid and grounded in reality to not own stocks for next year. So we commonly hear people talk about forward price to sales ratio, forward price to earnings, cap-Shiller ratio.
All of these are just multiple ways to...
So many ways.
Actually, multiple. So, that's what it comes down to. So we're trying to gauge the expensiveness or cheapness of the market. Happens to be expensive right now, but it can stay that way for a long time.
Yeah, exactly. So price to earnings ratio on a forward basis for the S&P 500, it's at 2050. So if they're at 2050 right now, what that basically means is that you're paying $50 to buy 1 unit of earnings. And the reason why people don't like them getting to higher levels is because that means you're paying more to get the same stock. And everybody likes to get a good deal, right? So we're uncomfortable, notably, because of that. I don't think that's a good argument, though, because of 2 data points. Number one, we actually did an analysis going back to 2015 where we looked at the most expensive stocks. And out of 10 of the top 10 most expensive stocks, 7 of them outperformed the S&P 500 over the next 5 years. So it's not necessarily...
Expensive isn't always bad.
Yeah, exactly. Price is what you pay, value is what you get.
Hey, Warren Buffett said that.
Yeah, exactly. So it's not really a good argument. And then second point, if you had paid attention to valuations, then you would have completely missed out. On the past 3 years long bull run. And as we're seeing, this year might end up being another 20% gain. So
Yeah, let's focus in on that, because I remember a year ago I was sitting here, we were talking to a bunch of people, and they were all saying, well, when you have 2 back-to-back years of 20% gains, well, then the third year you tend not to do as well. But here we are. I think we're going to be up 16, 17%. Full disclosure, we got 2 more days, trading days in the year, and maybe we hit that 20% mark, but we're getting close there. So it's unusual maybe, and I don't think it's happened since the late 90s, but what are your thoughts on this?
On a 4th annual year of gains.
Yeah, a big gain, double digit.
Really extraordinary, right? But it's actually not that extraordinary, we found out. So since 1928, there's been 12 instances where across global equity markets, they've notched 3 years of 20% plus gains. And out of that, 5 times there's been a 4th year of gains. So S&P 500 too could have that. Of course, history is not meant to be a guide. History is not meant to dictate our future performance. It can help guide us in the direction of where stocks could go. And how I'm really looking at this is as not completely discounting what could happen in the 4th year. Fundamentals look great. Going back to earnings, next year, analysts expect that we're going to have a record number of earnings, and they always overestimate it by a little. That's one of their reputations. But even if we cut it by what they typically overestimate it by, it's still going to be a record year of earnings. It's very, very good to see stocks rise when earnings are growing too, because it supports that rise. So I think it can still be another good year. And in the past 3 years, I think the median gain across those global equity indexes was 170%. And the S&P is only at 75 something. So there's room to grow. Maybe we'll have another 75% gain next year. But I'm joking.
We'll see.
I will say too, we're hearing from so many different firms, Goldman Sachs, Wells Fargo, even Edgar Denny, well-known person on the street. Yeah, very bullish calls about what 2026 could look like, and so it really supports what you're saying. Edgar Denny calling out for 7,700 by the end of 2026. That would probably about a 10% gain there. So definitely lots of bullishness that supports what you're saying too.
Yeah, it's funny when people say, well, over the last 80 years, the S&P 500 has averaged 8 to 10%, but it's almost never 8 to 10%. It's usually a lot higher or a lot lower. And so when you hear all these statistics, especially averages, medians, take it with a grain of salt. I think the bottom line is that we have a bullish potential for next year, and expectations are probably reasonable, as I think we've been discussing here. So let's keep it on the markets. What are you thinking about the markets that we haven't hit on so far?
The biggest thing I would say is gold.
Oh, gold.
Yeah.
Metals, let's talk about it.
Yeah. Silver,
up
copper,
65,
gold.
70%. Silver's up 170%.
It was not on my bingo card for this year at all.
Yeah.
That gold was going to have such a skyrocketing year, and silver too. Where did silver come out of, by the way?
Well, I mean, it's the AI trade, so it's an industrial metal, but I think you're right in that you have to have a perfect storm of not only industrial use, but also of speculation. And we saw that, I think, when you see gold kind of capture the imaginations of people buy the ETFs, they buy the coins, and it's all this virtuous cycle.
The
miners. And the miners. And the biggest purchasers of gold are the central banks, but that's kind of the steady backdrop. And I think it's the retail buyers that just are the marginals. But does Fundstrat have any big expectations for gold or Bitcoin next year? Because Bitcoin hasn't done as well.
Yeah, I wish I could talk about Bitcoin, but that's
Out of
for
your
Tom.
expertise. That's
That's for Tom. But gold, it feels so weird to see gold do as well as it has, while at the same time you're seeing tech stocks just going higher and higher in the AI trade. Maybe it's part of this defensive play that people are worried if AI trade falters, at least I'll still have my gold holdings and whatnot. But at the same time, it's like, who are these people that are buying all this gold? And it's unclear. It's central banks, sure, but what's happening right now for central banks to continue to amp up their activity? Because I think they started increasing their purchase in 23. 24?
I mean, so China and other countries, Russia, have been de-dollarizing since 2015. But you're right.
Yeah.
Over the last 3 years, it's been like 1,000+ tons per year. Tons. I mean, that's a huge number. So
what are they seeing that we aren't?
Right.
Well, I think they're looking at all the conflict around the world and saying, well, we don't know what's going to happen. Maybe we'll just double down on gold.
And I think also, too, the extraordinary run that silver and metal, these other precious metals have also seen. I read this crazy stat today, guys, that copper, I mean, obviously seeing lower supply, then leading to more demand, increasing prices there. But you think about it with solely data centers, as many on the street are focusing on, but think about how much copper is in the everyday American's home. And this stat that I read is the average single family house uses 439 pounds of copper in your wires, in your appliances. And so, I mean, what are the implications there? How much is it going to cost us to redo a house, guys?
Yeah, I mean,
About that one.
copper could become the new reserve currency here.
Yeah.
We do have to get to our final segment of the day. It's a market's take on a classic Hollywood gab show staple, Who Wore It Better? And today it's all about the battle to become the next Fed chair. It's Kevin versus Kevin. That is Kevin Warsh versus Kevin Hassett. On the left runway saunters Kevin Warsh in pure Wall Street tailoring, clean lines, sharp shoulders, and a little balance sheet trimming energy because he's a former Fed governor with an M&A background, and in the past, he has been a vocal critic of quantitative easing and also the bloated Fed balance sheet. Then on the right, in walks Kevin Hassett, an economist who's not too shy to bring his own spreadsheet, decked out in tweed, a growth lapel pin, and also a pocket calculator, a trained economist who's been a big voice on productivity and an architect of the 2017 tax cuts. So Hardika, the question for you is, who do you think eventually wears that Fed chair this May when Jay Powell gives up the top spot at the Fed?
So I'm going to have two answers.
Don't say
to this.
Kevin. Don't say Kevin.
Don't say Kevin.
Which Kevin?
Which Kevin? Okay. So I think the market's probably going to like Hassett more. I do think Warsh also could also be a good fit. So that's my cop-out answer. But Hassett, I think the market would like him because he isn't looking to redevelop or revamp what the Fed does and what the Fed's activities are, whereas Warsh, as you said, is so vocal about QE and going away from QE, which obviously could have huge implications for Wall Street. I do think that Warsh does have a point when he says the Fed's balance sheet has become bloated. They're becoming bigger and bigger. Whenever they stepped in to, calm the markets after financial crisis, they kind of never stepped away, even though the financial crisis...
Not in a big way. I mean, they ratchet up, not so much ratchet down.
Yeah, so it's a valid point, but I do think Hassett would be a better fit for Wall Street.
I think also, too, what's interesting is that both of these gentlemen have said that they plan to maintain the Fed's independence. What's your take on both these gentlemen and the ability for them both to do that?
This is going to sound funny, but I think at the end of the day, they're both Kevin. So whichever one goes in, it's okay. Because Trump has made it clear, the president has laid out the Trump rule saying that if they disagree with him on where interest rates are supposed to go, they will never be the Fed chair. If that's the outline, then whoever does come in will likely be dovish, and market's going to understand that. So I think the risk that comes then is what happens to long-term rates, because while the Fed has control over the short-term rates, the long-term rates, not so much. So the Fed's probably going to need to step in if long-term rates go up even more and start doing more QE, which then puts them in this cycle.
Or Operation Twist, which is kind of crazy again.
Yeah, that would be crazy too. But, long-term rates, that's where most of us feel the impact of higher interest rates. They affect mortgages, they affect your student loans and whatnot. So I think it's a tough spot, but I do think that at the end of the day, whichever one comes in, it's likely going to be a dovish Fed chair.
Yeah. And, I think you rewind the clock. There's always a little bit of hesitancy when we get a new Fed chair. Sometimes the market stumbles a little bit. But in the end, I got to think that most of the Fed chairs throughout history have leaned a little bit dovish. So that's my take on things. Well, it has been an absolute pleasure hosting you here, Hardika, at Stocks in Translation. And just to review some of the things we were learning earlier, productivity, the holy grail for central bankers. You can get that economic growth without the inflationary pressures, but that's all on the backs of workers who are doing more. And hopefully those workers have a good ChatGPT or Claude account that they can base that on. And then, we're also talking about the earnings for this season. We're going to have in a couple of weeks, we're going to get JP Morgan and the big bank earnings. We're going to see exactly how that shakes out. But there are big expectations for 2026 like there is every year. And I think we start off a little wobbly, but in the end, we usually kind of find our footing. So we have officially wound things down here at Stocks in Translation, but make sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We will see you next time on Stocks in Translation.